Hello everyone and welcome to this month's NFP preview. My name's Craig Erlam, Senior Market Analyst at OANDA. Now it's getting to, I guess, the business end of the year. I know that everyone always tries to big up the US jobs report. Of course, it is one of the biggest economic reports that we get each month, regardless of which country we're talking about. So I can't stress enough just how important it is in terms of an economic point of view, but also, of course, as well from a markets perspective. But like I say, every month people will always talk up the impact of it, and we've seen some months, of course, there will be a lesser reaction in the markets, and it will be seen as less important. Other months we will see quite a big reaction in the markets, and it will be seen as far more important. I do believe, in all honesty, that this is certainly one of the latter, because not only is it a penultimate jobs report of the year, and that is important for the very reason that we've got one Fed meeting left this year, and once again the Fed has hinted that December is going to be the point at which we are going to see that next rate hike. But it also comes days before the US presidential election. I'm not necessarily saying it's going to have an influence on the outcome, but what I will say is the polls have tightened up quite considerably recently, and obviously following the FBI reopening its investigation into Hillary Clinton's emails last Friday. And for those who are still on the fence, a report on the economy may potentially sway them. But even aside from that, the fact that there's only two reports left this year, the Fed stated yesterday that it would like to see more evidence, a little bit more evidence that the U.S. economy is improving, and I think that is, like I say, I think that's extremely important. It says the case for an increase in the federal funds rates continue to strengthen, but it wants to see further evidence of continued progress towards its objective. Now, I do believe this is obviously the case, but also I do think that the election in a few days' time did influence their decision. I think had there not been a presidential election, and that had been a press conference yesterday evening, I think they would have potentially been happy to pursue it. All you have to do is look at the fact that Eric Rosengren held off on voting for a hike on this occasion, having done so last time, and it would suggest that the election did play certainly on his mind, and potentially played on the others. But like I say, should we see a deterioration in the economic data, then that will potentially influence whether the Fed will raise interest rates in December, especially if we do get, I hate to say it, a Trump presidency, not that simply because the effect it could have on the markets, not from obviously a personal perspective. The fact that a Hillary Clinton presidency is seen as a more favourable because it means it means you get a continuation of the status quo, whereas Trump presidency throws up all kinds of uncertainties in relation to trade agreements, foreign policy, the economy, debt, etc. This is something the market does not like, uncertainty. So if we get this market turbulence on top of a stream of bad data between now and the December meeting, then that could throw into doubt whether the Fed will raise. And it's important to note here that if we look at the CME Group Fed Watch tool, the market, despite the turmoil over the last few days in the markets, despite that we've seen 4 out of 5 consecutive days of losses in the US dollar, the market continues to price in an above 70% chance of a rate hike in December. And as I've mentioned before, again, this isn't verified, but it has been suggested that the Federal Reserve has never raised interest rates in the last 50 years unless markets pricing it in at more than 70%. So this is quite significant. Market expectations for a Fed rate hike haven't really changed yet, despite 4 out of 5 down days in the US dollar, and quite significant down days, and a lot of political drama on top of that as well. It would normally have more of an impact. So when it comes to tomorrow's jobs report, what is it that we're looking for? Now, I think there's a few things that people always watch. The two most important are the unemployment rate and the non-farm payrolls figure, job creation, and what that does for overall unemployment. While these headline figures are always going to get the initial impact of the markets and are probably going to write the headlines for the newspapers and the online press, for me, they're not the most important tomorrow because they're not going to be the most important to the Fed. A drop of unemployment from 5% to 4.9% is, of course, important, and 175,000 job creation from the non-farm payrolls figure, if it's in line with expectations, would be very good. It would more than cover the additional people that will have entered the labour market last month, which, depending on who you talk to, it comes to varying degrees. But the most important thing, I think, as far as the Fed is concerned, isn't necessarily job creation. I think they're comfortable here. I think they're comfortable with the unemployment rate. Below 5% is pretty much in line with what the Fed traditionally deems to be full employment. The thing that they're most concerned is the other side of their mandate. It's inflation. And now inflation, barring 5 months a few years ago, has, as per the preferred measure of inflation, the core PCE price index, has been below its 2% target since the financial crisis in 2008. This, of course, isn't good enough. But since the middle of last year, we have seen a rising trend, and it's currently at around 1.7%. I think this is the area that the Fed wants to see. I think this is the area that Fed wants to see that continued signs of improvement, that it wants to see it hit its inflation target. There are a number of different indicators that would suggest that, one of which, and one of the most important in terms of sustainability, I think, is average hourly earnings. The Fed wants to see signs that earnings are growing in order to provide that sustainable boost for consumer spending and provide that sustainable boost towards its 2% inflation target without choking off the recovery. Now, as you can see here, earnings have grown on an annual basis at around 2.6% recently. This has been an improving trend, which will make the Fed a little bit more comfortable. I think the other indicator which I think they'll keep an eye on is labour force participation rate. Again, during the financial crisis, that has taken quite a hammering, and therefore you can see it's fallen to near all-time lows. I think the multi-year low was around 62.4%. It's still only at 62.9%. Now, there are certain reasons for this, for people leaving the workforce, such as retirement and so on and so forth, an aging population effectively. But I do think the Fed still views part of the reason for this to be that people are leaving the workforce because they can't find a job and they've effectively given up. Now, this is one, for a burden on the government, but for two, it's not a sign of a healthy labour market and a healthy economy if people are not working and are not searching for jobs. So I think the Fed would like to see this continue to creep higher in the coming years, or at least see signs that it is picking up. And if we see a lift in the participation rate, just to warn you, if we do see that jump to 63%, for example, then as we saw a few months ago, that could prompt the unemployment rate to actually go up rather than down. But I guess that'd be a good problem to have rather than a negative one. So this is the key indicators which we're looking for tomorrow. I do think the unemployment rate and the non-farm payrolls is what we'll get the reaction to first. But as far as I'm concerned, I think the Fed will be far more focused on things like average hourly earnings and the labour force participation rate at this stage. This is going to be interesting in my view as well. Federal Reserve Vice Chair Stanley Fischer speaking later on this evening. Undoubtedly, he will be questioned about the labour market data that day. Now, if we take a look at the charts, we can see we have seen that significant weakness in the US dollar over the last week or so. We have rallied up above 111 currently, where we have run into resistance. You can see that this was a previous zone of support, so that doesn't come as a huge surprise. We've also got the moving averages here, potentially providing some resistance. If we do head up towards around the 1180, 112 levels, then we could see further resistance from the descending trend line. But I think this is your notable barrier resistance for now. I think we'll have to get a pretty poor jobs report tomorrow for us to see a move beyond here at this stage. I think so far we are just really factoring in political risk here and less central bank risk, and the culmination of the two could be what triggers it a move higher, and a break of the descending trend line. Then we could be looking around the 112.50, 113s. But I do think it will take quite an abysmal figure tomorrow to prompt such a move. Also, we've seen some weakness in cable. Of course, again, driven by two things. One thing has been, of course, weakness in the US dollar, but then today we've also had the Brexit story with the UK High Court rejecting the government's notion that it can trigger Article 50 without parliamentary approval. That is effectively a win for the anti-Brexit campaign at this stage. Of course, that's going to now be appealed in the Supreme Court, so it's certainly not to say at this stage that Brexit will not go ahead. It's probably going to be a long process, but it is known that it's believed that around 75% of the House of Commons do not support Brexit. So then they'd have this dilemma of, do they go with what they believe and what they know, or will they go with their constituency? It's I think there's a long way to go in this process yet, but this was certainly given a boost by those reports earlier on today. Should we see a weak number again, though, we could be looking at around these 126 levels, I think, as your next major level of resistance. Beyond here, we could be looking at around 127 to 127.50, but I do think, again, it will take a significantly weak number in order to prompt such a move. Dollar yen has been seeing some weakness, but this remains in bullish territory. I must stress, it's above the cloud, it's re-entered the cloud from above, so while this is unfortunate weakness, the break of 102, 101.80 is what will make this a very significantly bearish move. That would see the lagging line and price action break back below the cloud, and that could signal a much more bearish move ahead. S&P 500, again, we are still seeing weakness. We have now seen the break of this level, so that is quite concerning. We're now below 2,100. I think 2,075 could be next, but really, I think that's quite a significant move here. I think should we see a break of 2,070 and this break of 2090 and then a break of 2070, then that could be quite a bearish indication. But already, to be honest, I think we've had that from the break of 2,100. Finally, I wanted to touch on gold, given the inverse correlation that we've got between the US dollar and gold. Now, gold tends to react to many things. It's a risk aversion tool, so it tends to benefit from periods of uncertainty, which is what we've had recently. It's recently been referred to an extent as the Trump hedge. So the fact that Trump has gained in the polls, which has spooked the market somewhat, then the gold has benefited from that back towards this 1300 level, which again is a major level of resistance here. 1315, sorry, could offer more resistance, and again up here around the 1330s could offer more resistance again if we do approach that level. But again, I do think it will take a sufficiently bad number in order to achieve that. So I hope that was useful. Good luck tomorrow for the payrolls. Hopefully we'll get a good number and the US economy can continue to improve. And then all we've got to look forward to is the little business of the US election next week. For more in-depth news and analysis, check out OANDA MarketPulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.